Have you ever noticed that almost everyone spends years working for money, yet very few people ever stop to ask what money actually is? We learn how to earn it, how to spend it, and sometimes how to save it, but the system underneath it often remains invisible. It quietly shapes nearly every decision we make while staying hidden in plain sight. That is the paradox at the heart of modern finance. The more familiar money feels, the less we tend to question how it truly works. Imagine walking into a massive building every day and confidently using its elevators, lights, and doors without ever seeing the machinery hidden inside the walls. You trust the system because it functions. Money operates in much the same way. We use it constantly, but the invisible engine that keeps it moving is rarely discussed outside economics classrooms, financial institutions, or central banks. Yet understanding that engine can fundamentally change the way you see work, savings, prices, debt, investing, and even global events. Money itself is not wealth. That statement sounds strange because most of us naturally associate the two. Wealth consists of valuable resources, productive businesses, useful skills, land, technology, infrastructure, and human creativity. Money is simply the tool society uses to measure and exchange those things efficiently. Before money existed, people relied on barter, exchanging one product directly for another. While this worked for small communities, it quickly became inefficient. Someone with grain needed to find someone who both wanted grain and possessed exactly what the farmer needed in return. Economists call this the double coincidence of wants, and it dramatically limited trade. Money solved this problem by becoming a commonly accepted medium of exchange. Instead of searching endlessly for the perfect trade, people could sell their goods for money and later exchange that money for almost anything else. This simple innovation allowed specialization to flourish. Farmers focused on farming, blacksmiths concentrated on making tools, builders refined construction, and merchants expanded commerce across regions. Productivity increased because people no longer had to master every skill themselves. Civilization became more interconnected, and economies grew more complex. For money to perform this role effectively, it generally needs several important characteristics. It should be widely accepted, durable enough to survive repeated use, portable enough to carry, divisible into smaller units, relatively scarce so it maintains value, and recognizable so people trust its authenticity. Throughout history, many objects have attempted to serve these purposes, including shells, salt, livestock, precious metals, and eventually coins and paper currency. Each represented society's ongoing search for the most efficient way to facilitate exchange. Gold and silver eventually became dominant forms of money in many civilizations because they possessed many of these desirable qualities. They were scarce, difficult to counterfeit, highly durable, and divisible into standardized units. However, carrying significant amounts of precious metal across long distances created security risks and logistical problems. Financial institutions gradually emerged to safeguard deposits and issue paper receipts representing ownership of those metals. Those receipts eventually evolved into paper currency, accepted directly in everyday transactions. Modern money, however, operates differently from the gold-backed systems that existed in earlier centuries. Most national currencies today are known as fiat money. Their value does not come from being directly redeemable for a fixed quantity of gold or silver. Instead, their value depends largely on public confidence, legal recognition, the productive capacity of the economy, and the institutions responsible for managing the monetary system. Governments accept these currencies for taxes, businesses use them for transactions, employees receive wages in them, and consumers trust that others will continue accepting them tomorrow. Confidence, supported by institutions, becomes one of the strongest foundations of modern money. This is where the invisible engine begins revealing itself. Many people imagine that all money already exists somewhere, simply moving from one person's pocket to another. In reality, the money supply changes over time. Commercial banks play an important role in this process through lending. When banks receive deposits, Regulations generally allow them to lend portions of those funds while maintaining required reserves and liquidity. Those loans finance homes, businesses, education, equipment, and countless productive activities. As borrowers spend the loan proceeds, the money circulates through the economy, supporting additional transactions and economic activity. Central banks occupy another critical position within this architecture. Rather than managing every individual loan, they influence broader financial conditions. By adjusting policy interest rates and using other monetary policy tools, they seek to balance economic growth with price stability. Lower interest rates may encourage borrowing, spending, and investment, while higher rates generally make borrowing more expensive, potentially slowing demand and helping reduce inflationary pressures. These decisions involve complex trade-offs because economies rarely move in perfectly predictable ways. Inflation provides another example of the invisible engine at work. Inflation simply refers to a sustained increase in the general level of prices over time, meaning each unit of currency purchases fewer goods and services than before. Many factors can contribute to inflation, including strong consumer demand, supply disruptions, rising production costs, or changes in monetary conditions. Moderate inflation is common in many economies, but persistently high inflation can reduce purchasing power and complicate financial planning for households and businesses alike. Understanding purchasing power changes the way people think about saving. Imagine placing money under a mattress for many years while prices gradually rise. Even though the number printed on the banknotes remains unchanged, the amount those notes can purchase may decline. This is one reason many people seek financial strategies that aim to preserve or increase purchasing power over long periods, recognizing that simply holding cash may not always maintain the same real economic value. Every financial decision ultimately involves balancing liquidity, safety, expected returns, and risk. Risk itself is one of the most misunderstood concepts in finance. Many assume risk simply means danger, but financially it often refers to uncertainty regarding future outcomes. Every investment carries some degree of uncertainty. Government bonds, corporate bonds, stocks, real estate, and business ownership each involve different combinations of potential reward and potential loss. Higher expected returns frequently accompany greater uncertainty, although no outcome is guaranteed. Understanding this relationship encourages more thoughtful decision-making instead of emotional reactions to short-term market movements. Another powerful component of the invisible engine is time. Time allows compound growth to influence financial outcomes. When earnings generate additional earnings over extended periods, growth can accelerate because future gains build upon previous gains. The same principle applies in reverse with debt. Interest expenses can accumulate over time if balances remain unpaid, increasing the total repayment required. This mathematical reality demonstrates why financial decisions made today often produce consequences that become much larger years later. Cash flow forms another essential piece of financial architecture. Individuals, families, businesses, and governments all depend on money flowing in and flowing out. Positive cash flow generally means incoming resources exceed outgoing obligations over a given period, creating flexibility for saving, investing, or preparing for unexpected expenses. Negative cash flow, if sustained without adequate financing or reserves, creates increasing financial pressure regardless of how valuable underlying assets might appear on paper. Businesses illustrate this principle clearly. A company may own valuable equipment, intellectual property, or buildings, yet still struggle if it cannot consistently generate enough cash to meet payroll, suppliers, taxes, and operating expenses. Conversely, healthy cash flow allows businesses to invest in innovation, expand production, hire employees, and weather temporary economic downturns. Looking only at revenue or profit without considering cash flow provides an incomplete picture of financial health. Debt deserves similar nuance. Debt itself is neither inherently good nor inherently bad. Its impact depends largely on purpose, affordability, repayment structure, and expected future benefits. Borrowing to finance productive investments that generate sustainable income may produce very different outcomes from borrowing primarily to support ongoing consumption without a realistic repayment plan. Responsible financial management, therefore, involves evaluating not only whether credit is available, but whether future cash flows can comfortably support repayment under changing economic conditions. The invisible engine also explains why financial news often focuses on employment, productivity, consumer confidence, interest rates, inflation, and economic growth simultaneously. These variables continuously influence one another. Strong employment may increase household income and consumer spending. Increased demand may encourage business investment, while also placing upward pressure on prices if supply cannot expand quickly enough. Central banks observe these developments when making monetary policy decisions, which then influence borrowing costs throughout the financial system. Each component becomes part of an interconnected network rather than an isolated statistic. Perhaps the most valuable lesson hidden inside this engine is that financial literacy is less about predicting the future and more about understanding systems. Markets will continue fluctuating. Economies will experience expansions and slowdowns. New technologies will reshape industries. Governments will introduce new policies. None of these events can be forecast with perfect certainty. However, understanding the architecture beneath them allows people to interpret change with greater confidence and less confusion. Once you recognize money as a measurement tool, banks as financial intermediaries, central banks as monetary policy institutions, inflation as a change in purchasing power, and cash flow as the lifeblood of financial stability, headlines begin telling a different story. They become pieces of a larger system instead of isolated events competing for attention. The invisible engine of money is not hidden because it is intentionally mysterious. It is hidden because modern financial systems have become so familiar that most people stop questioning the mechanisms supporting them. Yet every purchase, paycheck, loan, investment, and business transaction depends upon this architecture functioning with sufficient trust, stability, and participation. Understanding that architecture does not guarantee financial success, nor does it eliminate uncertainty. What it does provide is clarity. And in a world where economic decisions influence nearly every aspect of daily life, clarity may be one of the most valuable financial assets anyone can develop.